Get perspective on how IT as a sector looks right now in the light of these numbers coming out. Ajay Srivastava, market expert, is joining us on this edition of India Tonight. Great to have you with us this evening. Very good evening, Ajay.
Thank you
Your
very much.
largest takeaways, Ajay, from the IT earnings, TCS, Infy, HCL Tech, Wipro now. Is there a breakaway trend that you've noticed on any of the parameters that seems to suggest that perhaps we might be slightly getting out of the woods when the IT pack is considered by analysts?
I think one clear thing which came out was that the order book remains robust at this point of time. The new acquisitions, large accounts, have equally been robust, particularly for Infosys. And therefore, in terms of pure runway, I think they have a fair bit. What is also going to happen now, that they have got a huge benefit of the dollar depreciation, rupee depreciation. Almost 12% benefit has come from that, which might be missing next year. So just on a pure top line basis, I think you will have a serious problem next year for investors, just on an optical basis, that the growth will not going to be 17% or 14% thereabouts. It's going to be in low single digits, because hopefully we will not have a depreciation of rupee as we saw in the last year. So I think if you're an investor, and you look at, say, I need to make returns on my thing, not necessarily I don't want to make losses. IT is a great sector to be in. It's good dividend, buybacks, long-term trajectory, global companies, everything is good. But if you look at what's going to happen to the financial of this company, you'll be very wary of investing today, because come next year, quarter to quarter, there'll be a huge problem in growth rates of these companies, because they might not have the benefit of rupee dollar depreciation as much as so. Yes, some of them have taken future covers. They may still report good numbers, but the growth parameter is going to slow down, because 12% of this growth came from rupee depreciation, not from business. So I think purely on fundamentals, it's a good place for parking long-term money. Every correction you should do it. It's a great India story. But I think in the next 20 to 24 months, you will have trouble time making money out of it, unless the NASDAQ goes for a different trajectory altogether. So I think, if you don't have it, I think it's worthwhile buying it. But if you have it, adding up perhaps may not be the best idea. You could do many other things. So you don't junk it, but you don't top it up.
Right now, you'd wait and watch right now for all this dust to settle, as it were, Jay. But the world over, IT as a sector has been facing a crunch. And surely when you talk about the demand growth, and you did say that across these big IT companies, we are seeing robustness of growth in demand. Does that surprise you?
No, it doesn't surprise us, because I think as we go in further and further in the future, you need to be more competitive. There is a consolidation plays happening. Now, whenever two companies merge, banks merge or two companies merge, the integration of IT becomes one of the principal issues in every M&A today. That's going to happen. The expense has still not gone on to Europe, Africa, and Asia in the manner US. As our banks become larger, they will need to spend like a JP Morgan spends or a Goldman Sachs spends, etc. in the US. So I think demand robustness doesn't surprise me, because every part of the industry, whether it is supplies, whether it is manufacturing, whether it is retail, every data analytics, medicine, everybody is heavily relying on technology to make them more productive, reduce the cost, accelerate the market. So I think you cannot run away from the fact that today go-to-market has got technology written all over it. Therefore, the robustness will continue, and we are hoping that when the rest of the world catches up or tries to catch up with the US, you will see a strong trajectory of earnings. That's why I said, next 12 to 24 months, you will have a lot of issues because of the way reporting is done in India in terms of rupees. But longer-term trajectory of this company is absolutely fine. Now, and the best part, dividends, no governance issues, no dilution of capital, no leverage. Now, how much better can it get for you?
So operationally, you think they're doing all right in terms of current utilization levels? We've seen some amount of stabilization of attrition as well. How do you read that in terms of managing their resources in these difficult times? How do you think they're doing when it comes to margins and profitability? How are they playing that game to ensure that they don't face that much more of a crunch in this difficult period?
I think they've done a fabulous job, because what's happening now is, thanks to the attrition, the lower numbers have, in terms of the junior most employees, the numbers have gone up quite dramatically. So the average cost of people hasn't risen as much as we all thought it's going to rise, because they were handling attrition, the salary increase was taking place. But now it's all stabilized. In the new world, attrition has gone down. So I think the best part of the metrics that one sees is the ability to handle people cost. in relation to what we all thought is going to happen. They've done a good job. They recruited cheaper people and getting into it. And so I think the whole story is they've been able to deliver output to their customers with a much cheaper input cost called people compared to what all the analysts were projecting. And I think that operating metrics is now what is holding the margin firm. Look at any other industry. Every industry's margin has fallen. There's one industry where the margins are still where they are, which tells you how well they manage the input cost.
That is exactly what is going to be watched very closely. But when you talk about the sectors that will do well for the Indian IT sector, as this turnaround happens, which are the companies you think that are better poised to grab those deals wherever they may emerge? Because right now you've got to be agile. You've got to, grab whatever you can get and make it good for yourself.
See, I think what has come out very clearly is that, of course, TCS scores among the most in terms of profitability because they don't have any large ESOP cost at the end of the day compared to all other companies. Therefore, in terms of pure margin, TCS is unbeatable. How they do it, we don't know. But there's a magic in TCS that, without the huge ESOP payout that you see in all the startups and other companies, they manage their margins so well. And that's the difference between all other companies and TCS. Size and no ESOP cost, really speaking. The number two is, I don't want to pinpoint a company, but I would sincerely believe that among them, Infosys looks to be much stronger in terms of ability to get businesses because they have done two things. Their order book has increased. And number two is they have got very large size deals in the bag, even in this quarter, which tells you the story that they are targeting the right segment and they're able to close big deals, even though all the environment is not so good or the Christmas holidays are here. Now, that tells you a story about intrinsic worth of a company that if they can do it in this quarter, I think they've got a real good proposition for the customer. So I would say, you can pick and choose. TCS, a good dividend payout candidate. Infosys, a fantastic delivery person who can close large deals. But I think unfortunately, the list stops there because the third and the fourth and the fifth are just not there in the same league.
I'll ask you specifically about current valuations because a lot of experts are talking about how valuations are on the expensive side in these markets. When you look at some of these IT stocks, how do you think they are placed on the valuations front?
Vikram, I don't understand valuation. At the end of the day, the whole market is overvalued. Now, why would Titan growing at 10% be valued at 50 times PE? Does that make it better or worse? I do not know the answer. I think Indian context on valuation is more about demand supply. There is no increase in supply of IT paper in the country. These companies don't issue capital. Most of them do buybacks. And therefore, they become pricier and pricier as people are holding on to the core holding and the index has carried them. So I think, pricing wise, one can argue that if you're growing at 12, why is your PE 21? Yes, sure, a great academic argument. But the fact is that pure demand and supply of the paper of these technology companies, there is no increase coming anywhere. It's going down thanks to buybacks. So technically, you're having a scarcity value on the stocks of these companies that plays out in the cash market. And therefore, you can argue that, yes, they're expensive, they're cheaper, context to the market. But the fact remains, if you're a long-term investor, if it gets much cheaper, you have a right to add on to it. But to say that in context of the whole Indian environment, Indian market, are they more expensive? I would doubt it very much. The rest of the Indian market is far more expensive with much less defined runway for revenues compared to these companies. These companies have a clear runway there. Which other FMCG companies or other companies in India can give you this kind of runway assurance and the governance? I would say valuation fair and square given in context of what the rest of the market is.
Ajay, it's always a pleasure because you bring so much clarity about the entire sector because there are so many doubts as well and so many clouds that need to clear before we understand the trajectory of growth and how it's going to pick up. But you are quite certain it is going to pick up, but for the short term, you don't really need to add on more at this point in time at these valuations is what you're saying when it comes to these IT stocks. Ajay, such a pleasure having you with us. Thanks very much.
Thank you very much. You have a good evening.
You too.